Meghan Shue is Executive Vice President and Head of Investment Strategy at Wilmington Trust. Meghan, welcome. Good to have you with us.
Thanks for having me.
I want to go back to our first segment where our guest said that if you buy fixed income now, specifically I think he was referring to high-grade corporate bonds, in 12 months' time you're going to feel pretty good. You say underweight fixed income. Explain why.
Yeah, so we have held an underweight to fixed income for the better part of this year. We've chosen to hold our defensive positioning in cash instead. And I think that's broadly been the right move as we've seen interest rates move up. I do think looking forward over a 12-month investment horizon from these yield levels, even if you see rates move, let's say the 10-year moves 25 basis points higher, maybe even 50 basis points higher, for a diversified high-quality fixed income allocation, you're still going to be clipping a total return that's positive. That's very different from the backdrop where we started the year, sub 2% yields. So it's looking better, but it's been a really tough environment for that diversified investor looking for bonds to offset the volatility that we've been feeling in stocks. It just has not worked. But going forward, we do think it will work a lot better. And we're just waiting for that right time to add to our fixed income, most likely from cash.
I'm glad you clarified that because you're exactly right. If you had been, and he conceded the same, if you've been in bonds this year, it has been a bloodbath. It has not been a pleasant place to be, and one should have put that defensive capital, as you urge, in cash. Now I'm hearing you say we're inching toward that point where investment grade fixed income may be more attractive. Do I have you right, Meghan?
Well, we've used that cash as an optionality. And I think, honestly, if the market continues like this, we're going to have a lot more attractive options potentially on both the fixed income as well as the equity side. But, the point is that the pain investors have felt, and we talk to a lot of clients who are diversified who have just been totally floored by what they're seeing in their statements, mostly because of the lack of offset coming from bonds. And we're really urging them not to give up on bonds, but to hold a little bit less than we would in a full kind of strategic allocation.
So are there particular sectors that you think will hold up better given the economic weakness that seems generally to be predicted, and especially on a global front?
Well, the sectors that are going to hold up better in a period of economic weakness are clearly the defensives, consumer staples, utilities, maybe even real estate, depending on the pocket that you're looking in. But the problem is that valuations for defensives have gotten very expensive, and there might be a little bit more room to run there. But if you look at the historical relationship between valuations for cyclicals versus defensives, it's trading very low relative to history. So we've got a lot of pessimism priced into the cyclical part of the market. I would actually look not necessarily towards cyclicals, which might be financials, and we do have a slight overweight to energy, but other parts of the market, maybe more value-oriented, that are tied to the health of the economy. Instead, start to eye those pockets of secular growth, which have really taken it on the chin. We've seen that in the NASDAQ underperformance as rates have moved higher. And we don't see rates moving materially higher from here. So I think we're going to get, as soon as we find what that ceiling is on the rate market, which I think we're probably close to that peak hawkishness from the Fed, then that might become a more attractive opportunity for a long-term investor to get involved in that secular growth, maybe more tech-oriented parts of the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.